Hey there, welcome back to Fox Talks Finance, the final video in this series, talking through this 18-sheet bundle with the dashboard at the beginning there, having gone through the income tracker, expense tracker, the expenses are input monthly, the monthly cash flow and the bill calendar previously. Our final one in this series for this particular spreadsheet bundle is to talk you through the saving and investment scenario planning. So this tab's got two main sections. One here talking about long-term annual planning, and it's currently set up to model the impact of different saving strategies for retirement, to model what investment pot you end up with depending on a period of saving over a number of years. So in this case, set quite simply to have an age against each year and starting saving age and ending saving age. So three key scenarios which are broadly simulating the kind of start early, start late, start somewhere in the middle for saving for retirement. So in all cases here, the actual contributions are the same. The assumed rate of return is the same, set at 8%. Obviously, this is very much open to your interpretation and your particular circumstances, access to investments, risk tolerance, etc. But chosen 8% is a not unreasonable sort of long-term expectation for global equity growth heavy portfolios. This is along the lines of you have a retirement vehicles for savings, so you might have a pension, a 401k, SIP type deal, depending if you're in the UK, US, etc., or some sort of individual saving or retirement account where you can access those equities, hopefully with some sort of tax advantaging. But in any event, it doesn't really matter. The key here is it's not modelling the impact of any tax. It's just that you have got, for example, something like a Vanguard Global All-World ETF or investment fund. And historically, they've done more like 9 to 10%, but 8% is reasonable sort of estimation. You could argue somewhat factoring in a bit of inflation impact. So if you get more like 10%, 2% inflation, maybe 8's real, or maybe 8's more a conservative real, and you think after inflation you could be as low as 5 in real terms. But for simplicity purposes at this point, it's that's what your pot of money is going to end up looking like. The real buying power of this income that it buys later may well be. You have a different opinion on that, but for now, key here is 6,000 going in with a starting balance of 0, starting at the age of 20, stopping saving in this case of the scenario 1 here at the age of 30 and retiring at 60. This gives you an estimated value of retirement of 878,000 when in this scenario 60,000 only was invested. That then leads to the following section, which is a withdrawal rate set. So this is saying how much of your pot, your invested value, are you going to withdraw and spend to live on in retirement each year. So these are 5%. A lot of literature and culture of research that has been around, known as the 4% rule, originating from the Trinity study of the 90s by William Bengen. I'll stick a link to a set of reference material you may wish to look into, but the bottom line is 4% is considered somewhat the magic safe number, even accounting for very adverse periods where you're depending on your stock market portfolio's returns and there's a big drop for a number of years. Although the average might be 8%, if you have a very badly timed 10 years while you're withdrawing down at 5% and the market itself is down substantially over that period, you can end up running out of money a lot earlier. Hence, a safer withdrawal rate is a lot lower than the rate of return. So I've left it in at 5%. For me personally, I feel like that's, if you've got some tax advantage status and you have some flexibility, it's a reasonable number to look for, especially if you have a backstop like many developed countries do, to have a reasonable state pension system from your government or social security in your later mid-late 60s to supplement. So even if it didn't go so well, you could compensate your withdrawal rate once you get state pension kick in and maybe drop it to 4 or below 4 or 3. And there are a few other advocates that sort of suggest more like stepping that down anyway, because you're more likely to want to enjoy and spend that money earlier while you're more able to spend time with friends and family before old age sets in. So the annual income of 5% of that 878,000 pot gives you 43,901. And that's equates to a monthly income drawdown of 3,658 in scenario 1. It's not bad, 60,000 in, 3,658 out. So what happens if you were to start at 28 save the same amount, same assumptions. You even have a boost. Say you had 5,000 from another works pension or an inheritance or whatever it may be. Give it a little boost, and you keep saving until you're 41, and then maybe life circumstance, choose to work part-time, or the cost of childcare and some choices in the family mean that not in a position to save as much from a certain time for a period of time, whatever it may be. In this case, you end up investing 101,000 in and end up with a pot a fraction smaller despite a bunch of extra investment going in, because obviously you didn't start until that 5 years later, and the compounding of that extra period had an impact. But overall, not coincidentally, these values add up to 800 something thousand pounds, would be a little over $1 million, and they're targeted to illustrate the amount of savings in, depending on the time starting, to get you a similar amount of income. So in this case, 43,280 or 3,607 per month. Scenario 3 here finally models what happens starting at 30 years of age, with 10,000 boost. Again, same story. Say you consciously set to plan for retirement from 30 after having somehow accrued that 10,000 in previous workplace pensions. In this scenario, keep saving all the way through to 60 years of age and accrue slightly lower £848,000, despite putting in over triple that first scenario, 190,000. Again, the same set of assumptions, a fraction smaller income, a slightly smaller balance, 42,361 annually, 3,530 per month. And we've got a nice graphical illustration of this and a table illustrating the expected balance, and it keeps going on, showing continued growth. And that is because this is purely modelling, very simplistic, 8% return on the way up. Stop contributing at some point, start withdrawing at some point, but obviously you're withdrawing 5% when you're assuming it grows at 8%, and growing in the region of 3% even with that. So it does taper off. This, instead of having a exponential growth, it's being slowed down. But in reality, the reason we've set this even at 5% is considered a little bit aggressive, is depending on the sequence of returns, that could run out potentially. The science is that with a 5%, you're probably towards 60% sort of success rate, judging on performances of global stock markets or US stock markets over a 30-year period, looking back historically. And you there's a few caveats around. There's a lot more to it than that, but you want to be somewhere between 50 and 100% in equities, ideally. There's too little in stocks or equities, more fixed income or cash, then the inflation cause a lot more damage than the potential volatility of the stock market, and you'll end up a lot worse off. But the point here is, if it goes well, you'll end up with a lot more money at the end. And the studies show that sort of average and median population expectations for value 30 years after retirement are likely to be significantly higher, sort of in the region of 3 to 8 times higher than the starting balance. But there is a number of occasions over time. Worst point of something like the dot-com bust, if you were to start drawing down retire exactly at the peak of that, the stock market kind of nearly catches up for the 2007 through 9 financial crisis, and it takes you about 13 years before you're really, in nominal terms, back above. So if you've been drawing that down throughout, not a good place to be. So a little insightful situation to help you plan your scenario. Obviously, yours may vary. You may be retiring early or later, starting early or later, have a different starting balance. You dial in your own rate of return assumed, and likewise withdrawal rates. So on the right hand side, we've got an extra section here. So this is about monthly planning, whereas previously we were modelling years. In this scenario, we're modelling months. So what we've got is here sort of typical scenarios you might use this for over a few years to pre-retirement, sort of 10-15 year windows. So in this case, you've got saving for a house down payment, saving for a next car, saving for a children's education, and using starting early and investing to help lessen the total burden of that cost for that, or just a simple long-term savings to leave a gift to your children, to buy something in the future for your retirement, to pass on your inheritance, whatever it may be. So in the house down payment scenario, I've got a 7% rate of return assumed, because this is clearly money you're going to need in a few years. This is modelled to be a 3-year saving period from today. modelling a slightly more conservative asset allocation. So this is saying you might be 60% equities, 40% stocks, or somewhere in that region, because you don't want to be at the point where you're about to buy a house in 3 years' time, have a stock market crash 20, 30%, 40%, even in extremes, and wipe that out. So that's one scenario. Another is for a car. And this is a bit of a novel way of saving for a car. So you're saving for a car for a 2-year period, and then you actually start withdrawing from your savings to help fund finance payment for a car, for example. So you could have got to a point where you could either pay as a deposit, or you could potentially draw down on it then over the next few years and be in a position to stop contributing and pay $550 a month for a car after you've given yourself a head start of saving £300 a month for a 2-year period. You can see the key here is this rate of returning, getting ahead of the withdrawals, such that even though you're drawing down there on the balance, you can see the red line is going down, because you've got to give it a head start. It runs a lot longer, and on average it will last those 4 years. But again, sequence return wise, it's a risky way to play it, but a lot less risky than just cash flowing it from your income. If you've got excess income, then you can accrue the savings. That's a good way to have a hedge against loss of income or change in circumstance. Next one, a bit more complex. This is planning for children's costs or education, whether it's a nursery school, private education, university education, whatever it may be, just the cost of having children. This allows you to model starting a savings rate, a pot of money put aside, rate of return assumed in this accumulation phase. In this case, putting in £800 a month for a 7-year period. This is more like funding university or private school. And then we switch to a withdrawal every 4 months. So this row here is detailing the rate of return in drawdown, how often you withdraw, and how much you withdraw. So in this case, it's like a university education or private school, £7,500 every 4 months. It's modelled as. Timing may vary, but for mathematical purposes, not particularly significant. And in this case, you don't stop contributing. Where you did for the car, you don't stop contributing for this education. So you keep paying in that £800 a month, even though you're drawing periodically more than 800 at the peak, less than in the beginning, or none in the beginning, more than at the peak. So in this case, you've ended up investing 101,000. I haven't created what you've had, but you obviously had, in this scenario, I've mapped 9 years of drawing out 22,500 a year, and you've put in 101,000. So clearly you've had some help from the investment pot there. Sorry, 120,000. So you've started at 20,000, ended up with 48. So a total of 121 went in, and you've managed to withdraw 9 years of 22,500, getting off 200,000. Plus you ended up positive. It's the power of planning ahead, starting early. Actually, in reality, this would be a jagged line. I've got a more advanced version, but for now, this is a simplistic approximation of riding that wave and helping it work for you. And the final one is very simple, long-term, smaller payment over a long period of time. So it's a 15-year period in total. And you're putting in 36,000 to get 155. And again, like the retirement account, over that 15 years, you're getting into the period of the investment returns doing a lot of the work for you. So this can be flexibly adjusted to your scenario. Obviously, you may have different reasons you want to do this, and you might be withdrawing it annually or less frequently. That's fine. Use it as you so please, and you can update the scenarios and update the table. And again, obviously, a table is just showing what's happened, and in these cases where you've got an end date, it drops to 0, representing a withdrawal. Okay. Any questions? Please get in touch. FoxTalksFinance, finishing up. Thank you very much.